fact, let's go back to ES. So this is ES, right? If we go back to our usual time frame, this is the structural high, right? And this is the structural low. So we're projecting the fib like this, but the way you want to understand this is like this. So the market will create highs and lows, right? So we'll see a break, we'll have somewhat of a pullback, we will see a break. And now we're trading in this sort of position here. So the way you want to understand market structure is like this, right? You have a structural high, structural low, structural high, and structural low. And so the question now becomes, you want to be buying below old lows and you want to be selling above old highs. So this entire concept is about buying below the old lows. So that's what was happening here. So this was an old low, and we're typically looking for longs, or we're looking for higher prices after we've broken a previous low, right? That's basically how market structure works in a nutshell, right? This is the basic format we're following. So once we see a relevant correction here, again, we use order flow to confirm our levels. Once we see a correction, right, this now becomes our structural high, this becomes our structural low. And so this now becomes our premium and discount. So this is premium, this is discount, and we apply that on the charts. So it's about using these basic concepts to your advantage. So if we just take a look now at more recent price action, these were sort of my levels. And so this is the most common question I get. How do I find my levels? I'm not going to go over that in this video, but I'm going to go over key level 1, because key level 1 is the easiest to identify. So if we just go back to Tuesday, right? Tuesday, what we had here is a fair value gap. So I'm just going to break this one down. We had a 15-minute imbalance over here, or 15-minute imbalance. You can call it a fair value gap, you can call it a void, whatever you want to call it. So once we have this void in price, right, we're looking for that candle before price. So this is the candle here, this one here, just here. So this is the fair value gap, this is the key level. And so key levels are only valid when you can understand what was going on inside of them, right? So this is a key level because, not because there's a fair value gap, but because, yes, there's a fair value gap, but more importantly, price acted as supply, price then acted as demand, price continued to act as demand. So what we can see here is supply flipping to demand, again holding as demand. So this is a key level, not because of the fair value gap, but because there is limit orders resting over here. So what makes a key level? Or, as I like to call them, a better word for them is absorption levels, right? Because the market does not have to respect your fair value gap or anyone's fair value gap, right? The market will gravitate towards where there are limit orders. And I'm going to be breaking this down. So limit orders are what creates levels. Limit orders create levels, right? Levels themselves are not created from any of the following: sweeps, fair value gaps, SMT, Elliott waves, right, let me just spell that right. Elliott waves, right? SMC, random lines. I'm talking about support and resistance, right? VWAPs, right? None of these things create key levels, right? The only thing that creates key levels are limit orders. You can use fair value gaps to find voids in price where the market is more likely to react to. Now, just because there's a fair value gap does not mean there's a key level, right? You want to ditch all these and you want to focus on one fair value gap, and you want to see there's sell limit orders here, there are buy limit orders here, there are buy limit orders here, right? So this is key level 1 because the market has shown you that there are limit orders resting in this area. Now that same logic applies for key level 1, 2, 3, 4, and 5. So all of my levels follow the same